everybody. As always, it's Friday. That means it's another new morning and opportunity to look at our Rebel income trades. The market is open for business, and we are off and running. Excited to see you here. Hopefully, we'll get a few more people coming in as we get things rolling. A couple of simple things just to try to help with the live stream a little bit. Um, since I'm making this live stream available publicly, I want to try to encourage as much exposure and participation as possible. So if you like the things that we're talking about as we go along, go ahead and give the live stream a like. YouTube likes that and responds to that. Also, feel free to make any comments that you have in the chat area as well. I'll be paying attention to that throughout the course of the live stream today. And thank you for the like. That way, if you have any questions, comments, I like to try to make sure that we're getting as many perspectives about some of the things that we're looking at and talking about throughout the course of the live stream. So I pay attention to that and try to respond to those and fold those comments and questions into what we talk about today. Second of all, for those who may be new to Rebel Income, maybe you weren't familiar with the Rebel Income system. The focus in this live stream is to talk about how the market is working under current market conditions relative to the trades that we place in the Rebel Income system. Those trades are centered around income generation using the options market. Now, what does that mean? Well, where most people tend to buy options outright, if you think a stock is going to go up, you usually buy a call. If you think the stock is going to go down, you buy a put. We take the opposite side of the transaction. We're option sellers rather than buyers. And so we're looking at things from a little bit of a different lens. And that includes not only trying to generate income through those sales, but also trying to understand the dynamics of the companies that we're working with. I look at put selling specifically, since a put option gives the buyer the right to put the stock back to the seller, me, at any point if the stock is below the strike price that I've sold. I really put a big focus on the fundamental strength of the business and what I believe is the overall fair value of the stock itself. If I think the stock is discounted relative to the value of the business, then that is a stock that I think is going to be a good opportunity for the kind of income trade that we focus on. And so what we're going to be talking about in the context of the different trades that we're analyzing today and the different conditions that we evaluate is all focused through that lens. Okay, with that said, let's go ahead and dive in. Part of the reason that I like to do this live stream on Friday is because every Friday is an expiration Friday. Many of the stocks on the market offer weekly options, and that means that every Friday there's a new batch of options that are expiring, going away, and then moving on to the next week. It doesn't mean that there's always trades on deck that we've placed in Rebel Income, in the Rebel Income system, that are expiring, but it does mean that there's a lot of dynamics going on that can shift not only stock prices, but also that influence the movement of options as well. And so even if there are positions that aren't up for expiration, we always have opportunities to evaluate what's going on with the stocks that we're following, that we're paying attention to, and to see if what's going on changes some of the decisions that we need to make. Now, with that said, this week there are 3 trades on deck that are set for expiry, so we're going to be diving into those. We're going to start then with Campbell Soup. This is a put sale that I placed at the end of July. So this has been about a 3-week trade, and I sold the $32 strike price. Now, by selling $32 strike, I was able to bring in a little over 2% for that 3-week period, which is really a nice premium in and of itself. Now, one thing about put selling is that there's no additional upside. Unlike buying the stock outright, if you buy it at 32 and it goes to 37, you have an opportunity to make $5 per share if you own the stock, right? Well, with put selling, you're limited. Your total profit is limited to the premium that you brought in. Now, I'm okay with that, especially because I focus on short-term options. I typically look to sell no more than a month at a time, and if I can go less, then I will. And as you can see on the duration column here of my track record, it's actually pretty rare that I go even out to 30 days, even though I will do it. Even rarer that you'll see me extend out more than 30 days. It's just not something that happens very often. So by selling short-term options, I'm able to compound the effect of my put sales. In the case of CPB, for example, a 2% premium, a 2% return for a 3-week time period works out to a pretty good overall nice result. And you can annualize these numbers. I'm just giving all of this kind of as a foundation understanding of some of the things we're going to be looking at here throughout the course of the rest of the live stream. This trade covered a 23-day time period. So to figure this out on an annualized basis, I'm going to divide 365 days by 23, and that gives me 15.86. In other words, what this means is that if I were able to reproduce the same result, if I were able to place the same trade every 3 weeks, I would place about 15 trades. I'm always going to round down rather than up in this case to be more accurate and more conservative. Now, the truth is the times vary. Sometimes it's shorter, sometimes it's more, but I'm just trying to work with simplified numbers here as much as I can. Since I was able to generate 2.03% on this one trade, then I'm going to go ahead and multiply that, 2.03 times 15. And that means that under ideal conditions, if I were to recycle the same capital that I'm using to reserve the put sale every 3 weeks, then I would be able to realize about a 30.45% return on that capital. Now, let's talk about cash reserves for a moment, because that's something that becomes pretty important here. Now, when you're selling put options, you can either do them on a quote-unquote cash secured basis or on margin. Margin type trading. Hello, Jay. Welcome. Glad you're here. Margin trading is only available in cash accounts. So if you're trying to apply these strategies in something like an IRA or a qualified retirement account, margin is not available. You're going to be working on a strictly cash secured basis. Cash secured means that you have to have enough cash in the account to buy the stock that you're selling the put option for before you're going to be able to place the trade. And this is true. This is true no matter what your options permission level is. You have to have obviously you have to have permission from your broker to be able to place put sales. And just because you may have options trading authority doesn't mean you have put selling authority. So you have to check with your broker to make sure that you do. But here's how cash secured put selling works. I sold for Campbell Soup one contract. That's one put option. Now one option contract controls 100 shares. So selling one contract with a $32 strike price means the buyer can force me to buy Campbell Soup for $32. So I'm going to multiply 32 times 100 shares. And that means my total obligation is $3,200. Now, in terms of overall size of the trade, that's pretty conservative, and that's on purpose. I try to be very, very conservative with my position sizing rules. But what that means is I need to keep that $3,200 in cash in reserve through the duration of the trade. So since this expires today, that's $3,200 that I can't do anything else with until the trade expires today, or unless I do something to settle the trade before the market closes. So with that in mind, let's take a look at what the stock is actually doing today and see what that means for this put sale. Let's see, CPB is right here. Okay. So the stock has been really just kind of basing for the last several weeks. The low end is a little bit below 32. The high end of this consolidation range, we can probably call it 33 in a little bit, but I'll just call it 33. So 33, apologize for the bad handwriting here. And we'll call this 3150 just for simplicity. Okay. The stock right now is rallying a little bit. It's just a little bit below 33. So it's about 84 cents away from 83 cents now, away from the strike price that I sold. So as things stand right now, since the stock is above the strike price I sold, it looks like this option is going to expire worthless. Is that an ideal result? Those of you that are here and you've been working with these trades for a bit, many of you, go ahead and let's open up the discussion a little bit. Is it an ideal result when a put sale expires worthless in your mind? Jay, nothing wrong with that, and you're absolutely right. Nothing wrong with that at all. Gibbs says, yes, it is an ideal result. Okay, excellent. Now, I want to put this, the reason I've asked this question, Barry, that's usually the goal with this method. I'm going to differ just a little bit. It's not exactly the goal. It is probably the most common outcome. And that's, I'm not going to say that it's exactly the goal. So I'm going to differ a little bit from Barry's statement. Not that Barry is wrong. This is the way that I do this with Rebel Income works a couple of different ways. I treat put selling as a gateway to stock ownership. That means that I never sell a put option on a stock that I am not willing to own outright. That means that if I am assigned a stock because the stock dropped below the strike price that I sold, if I'm assigned those shares from the put sale because the stock is below it, I don't take that as a bad result. In fact, to me, that's not less favorable or more favorable necessarily than having the put option expire worthless. Being assigned the shares means that I will be able to have an opportunity to hold the stock for a little while, possibly make some money in capital appreciation. Since I work exclusively with dividend paying stocks, it also means that I may have an opportunity to bring in passive income in the form of dividend payments. A lot of that depends on how long I end up holding the stock. Put selling, again, seeing the option expire is not a bad result. It's a good result, in fact, because it does mean that the $3,200 that I've put on reserve for the trade will come back into my account. I'll be able to redeploy it, and whether that's back again in Campbell Soup or in something else, it's going to put that capital back, give me flexibility to make other decisions, and that's not something that's a bad thing. Gib, is there some point to think about I was wrong? And I love that question. That's a really, really good question. And again, thank you for helping us expand the conversation a little bit. I want to get everybody else's perspective about that. How would you answer that question where you think, wow, this was a bad decision? Did I make the trade at the wrong time, Jay? Okay, so maybe if that's the question, was it too close to earnings? Okay. Again, these are rather than right or wrong answers. I think these are generally preferences, personal preferences that we may have, right? Barry, I believe that is more evident when dealing with stocks that have no fundamental value, and I agree with that as a core principle, Barry. Thank you very much. But I think timing is an interesting question. Earnings is another one. I'm not necessarily using put selling as a timing method. I work with stocks. My focus is on trying to find fundamentally strong stocks at discounted levels. Campbell Soup is clearly at the low end of a very, very long-term downward trend. That makes my trade more than a little bit contrarian by nature because most people are not looking at Campbell Soup as an opportunity to buy right now. If they were, it would be trading at a much higher price. You'd see much more positive price action than what we've seen for the last year. Excuse me. So that means that I'm not exactly trying to time the trend or swings in momentum, those kinds of things. I do look at the charts and I do evaluate what near-term price action looks like, such as the consolidation range that CPB is starting to settle into. And to be honest and completely transparent, these kinds of ranges work really, really well for income generation and the kinds of trades that we focus on, like put sales, covered calls, those kinds of things. But timing is more of a secondary or even tertiary consideration as opposed to the focus on whether or not it's a fundamentally strong stock and whether or not its discount is worthwhile. Earnings is another really, really interesting subject. And that's because the closer a stock gets to a new earnings release, the more the volatility of the option starts to increase. That creates kind of an interesting dilemma for a put seller because increasing volatility in the stock increases implied volatility in the option. Increasing implied volatility in the option increases premiums. It inflates prices for buyers. And so for the sellers, in those cases, we can make a lot more in premiums, we can increase the yields on our income trades around those time periods. It's one of the reasons I don't necessarily avoid earnings. However, it is a period where, since volatility is increasing, what you're going to see are wider than normal swings between highs and lows in the stock. So if you are going to be trading around earnings, you have to do it with that understanding. That also means that if the stock does finish below the strike price that you sold, it could be quite a bit more. Gibb says, I love high implied volatility. Yes, and I generally agree with that. It doesn't automatically mean if the stock is coming up on earnings. For example, Campbell Soup their next earnings announcement is on the 3rd of September, which is just a little over a week away, right? That means that implied volatility for Campbell Soup is going to be going up. Am I going to be looking to place another trade in Campbell Soup? Maybe. At the same time, understand that since the stock can be volatile around earnings, here's just a little bit of a look at what has happened following an earnings announcement. We saw the stock break down below 34 and find a low around 30 from June to July. That's volatility. Here's March. Initial surge all the way up here to what is this, about 42, and then boom, a drop back down into the $37 range. So here's another one. Here's December. We saw a gap overnight based on earnings. And all of these have provided some momentum to keep the stock's downward trend going because of the way that the market has responded to whatever was in those earnings reports. Ironically, those same earnings reports that the market has used to beat the stock down have also showed that the business is strong enough that the value proposition for CPB is really, really high. That's why I don't necessarily avoid, one of the reasons I should say, that I don't necessarily avoid placing trades around earnings, but I do go in with my eyes wide open, understanding that some of these kinds of gaps can happen. Just because they've happened in the last 3 quarters don't automatically mean they're going to happen again. It just means that they could. It's not atypical. And that's something that I have to understand and be willing to accept. A lot of people in our group, a lot of people that I've talked to about income generation and these kinds of trades simply don't place trades around earnings for all of these reasons. And that's fine. That's totally understandable, and I'm not going to disagree with it necessarily, because it's just what you do is you identify the conditions that you're willing to work with and the conditions that you aren't. And so it really just depends on the individual and what your preference is. If I am publishing a trading alert for a stock that is around an earnings announcement, includes that earnings announcement, I'm going to try to make sure that I include that information in the trading alert. Barry, go back to your comment here. I believe that it's more evident, the idea here that is there some point to think about I was wrong. That you say that's more evident when dealing with stocks that have no fundamental value. I really like that answer. And fundamental value to me is ultimately the core question. A lot of the analysis that I do, both around fundamentals and valuation, are not only based on metrics that are commonly used to identify fundamental strength, but they're also rooted in principles that I've learned through a lot of study about things like free cash flow, about fundamental strength, about value analysis. One of the I guess most influential readings or influential books I read about this came from a man named Benjamin Graham. This is the guy that tutored a very, very young Warren Buffett many decades ago, and taught him the things that turned him into one of the world's most successful investors ever. He wrote a book in the 1930s called The Intelligent Investor. This is a book that has never gone out of print. And not because of his connection to Warren Buffett, it's because the book is this good. It really dives into how to evaluate a stock and the business behind a stock to determine what a business is worth. One of the core principles that Mr. Graham based his own investing method on was, if the business is worth more than the stock's current price, timing doesn't matter. If that value proposition is there, if the business is strong enough, even near-term volatility doesn't matter, because the market eventually is going to recognize that inherent strength in the business, and it's going to price the stock accordingly. That turned him into that philosophy. Got him and his partner through the Great Depression as investors, and put them on a path that, aside from the notoriety of Mr. Buffett, would put him without question, among the most successful investors of all time. So, Barry says you can try to catch a train on a highly tradable stock, but then it just collapses once the market's done with it. I've been caught in that, and I think we all have. And that's one of the reasons that I like to focus so much on value and on the fundamental strength. Trends are great. Price momentum and sentiment are fun to watch and even fun to trade sometimes. But if you want to talk about what is going to be sustainable, what is going to provide the most consistent results, Time has proven that value analysis is one of the strongest and most effective ways to find those kinds of opportunities. So you can stay too long at the party. That is also true, and that's why valuation matters to me. Carl, you say this is about portfolio building. That's right. That's why I look at every put sell as an opportunity to own a stock. If I don't like Campbell Soup, if I wouldn't be willing to own the stock, I'm not going to sell the put option. That's 1,000,000% correct. I love that comment. And to the point that you can stay too long at the party, that's where my valuation analysis comes in. If a stock even a company that I really, really like, if their stock has elevated and it increased in value to the point that it no longer offers the kind of value proposition I need, I'm not going to trade it anymore. Let me show you an example right now. CVS. This is a stock that I've used a lot over the last several years, and even had some recent trades in it at a lower price. The last trade I placed for CVS expired, in fact, just last week at 63, with the stock moving up here at 68. And we can see now it's pushed up to 72. So it's got this really interesting, and for momentum traders, a really fun rise just in the last few weeks from around $59 all the way up here to 72. That's really fast. It's a lot of fun. I'm not trading it anymore. When I placed that last put sale that expired last week, the value proposition, the discount for CVS was about 12, 13%. So it was already starting to approach levels that weren't quite as attractive as what I usually prefer. My actual fair value analysis for this stock puts its fair value price at about 71. That means that CVS now, at its current price, is just a tad bit overvalued. Now, that doesn't mean the company is bad. It just means the valuation has reached a point where it's not practical to work with in the same context that I've built Rebel Income around. So still like the company. I'm still a fan of the stock. I'm still going to keep watching it. I'm going to keep it in my watch list, but I'm going to need to either see the fundamentals see a big increase to catch up with the increase in price, or the price is going to have to cycle back down again. And I can be patient. I can wait for either one of those to happen. So Barry, again, you can also get caught with a good stock going through a bad time. Those are the long-term trends like CPB, right? And if you've been holding the stock through that downward trend, then you know exactly what Barry's saying there. It's not pleasant, but you have some confidence that it will most likely rebound at some point in the future. We can't time the rebound. We can't time the reversal. You can try, but trying to time a downward trend reversal is about as easy as trying to predict the weather. And some might say that predicting the weather is a little bit easier. I don't know. Anyway, you're exactly right. The core question comes down to what the overall strength of the business is, and so that really becomes one of the things that you have to focus the most on, and that's the basis for whether or not you're going to continue to hold the stock. So, Gib, I do use trends a lot, but it must pass the value proposition and the fundamentals, and that's exactly right. I absolutely pay attention to trends. I absolutely pay attention to near-term price momentum and sentiment. I'm certainly not saying that I don't, because that is exactly true. Those are like I say, they're just one component of the overall system. The actual investing decision for me is based on the value proposition and the fundamental strength. Okay, so Campbell Soup looks like now we're in the time we've been talking about this. It's rallied up a little bit higher, pushing very close to 33 right now. Let's go ahead and take a look at the option and see what kind of choices that makes available. Probably not much. Okay, here is the contract that the strike price that I'm working with. Here is the put sale. Asking price right now is showing at 70 cents. I can guarantee you that's because the option hasn't changed. There's been no trades on this. Now, this with the stock pushing up towards 33, this should be quite a bit less, but with no activity, that's going well. Okay, there's been one trade at 5 cents. I take it back, not no activity. And there is enough open interest here, but the Charles Schwab at least hasn't adjusted the asking price lower. So let's work off of the days range here rather than our normal bid and ask. This is pretty normal for the last day of expiration. Now, since I sold the option for 65 cents, this does open an interesting question. Is there an advantage to buying my option back before the market closes today? Or should I just do what I usually do? My normal method here is to let the option expire, and the result is the result. What about maybe putting in a buy to close order for 5 cents or 2 cents, 3 cents, something like that? Is there an advantage that would give me? And if so, what is it? Jay, you got your money back sooner. The only advantage is freeing the funds, and that's true. That's actually exactly right. And I'll replace only. Not that I disagree with you, Gib. Not only the major advantage is freeing the funds, as Jay says, getting the money back sooner. As I mentioned earlier, I sold one contract here, so I have $3,200 in reserve. It's $3,200 I can't do anything with. Now, that's not a problem. I've got plenty of other liquidity in the account to work with. But the $3,200 that are on reserve for this trade right now, if I let the option expire and it is still above $32 at expiration at the end of business today, trade settlement is going to take about 1 to 2 days. And that's not 1 to 2 days meaning Sunday or tomorrow. That means Monday, Tuesday. These are business days we're talking about. That means the earliest that I'm going to be able to use that same capital for another trade, whether it's Campbell Soup or something else, is going to be Tuesday, possibly Wednesday. It's part of the reason I publish my trading alerts when I do, not necessarily because I'm trying to reuse the same capital. It's just I've structured the trading plan in part around trade settlements. Buying the option back before the market closes makes those funds available immediately as soon as the trade closes. Now, if I put a buy to close limit order in for this option at 3 cents, 2 cents, I may have to wait for a little bit to see that come through. Means it's not going to happen immediately. There's enough open interest it could, but more than likely I'd have to wait for it a little bit. If the trade is placed with enough time before the market closes, I may be able to redeploy today, which is interesting. If not, then it would be Monday because of the weekend. But here's what doing this actually means. Okay, here's Campbell Soup around $32.96 now. Let's just go ahead and refresh this just to make sure. $32.96, sure enough. Let's go back to our options. The $33 strike price, even though it's a little bit in the money, is also at the money. Considering the level of strength here, it's also the most likely to provide something to work with. Well, this is interesting. So 7 days, we got a $32.50 strike price. There's no bid price shown here for $32.50 for 1 week. Take a look at this contract. This is interesting. So this is a contract at $32.50, a little bit below the stock's current price. There's enough open interest here to be interesting, enough volume to suggest that you could get a trade. So let's suppose that I went ahead and I bought Campbell Soup back. This is not a recommendation to buy or sell. As always, there's my normal disclaimer. Keep that coward's door swinging. But with the trades, the day range here between 45 and 40 cents. Let's go with the lower end at 40 cents. And talk about what that means. That doesn't sound like a lot. But remember, this is a 1-day trade. So let's suppose I bought the option back at Campbell Soup, and I got that trade to close before the market closes today. So I'm able to redeploy the funds again today. And then we're able to sell the $32.50 strike price. This is still a little bit out of the money because the stock's pushing towards 33. And the momentum suggests that the likelihood that this could also expire next week is pretty good. So it's available. We'll go with 40 cents. If I divide that by $32.50, now this is a little bit higher reserve requirement than the $3,200, right? It's $32.50, but still. That's a 1.23% yield for 7 days. Now let's think about that for a moment. Remember, when I do the annualization analysis, these are idealized results, right? Also, it's very, very simplified. You're not likely to actually be able to do this every 7 days, but for the purposes of simplification and overall putting the kinds of opportunities that are in place here in a practical result, 1.23% by itself may not sound like a lot, but when you can do that for 7 days of time, let's multiply this by 52 weeks. That's 64% annualized return on the capital that you've committed to that trade. Even if you're only doing a portion of this, you're getting between 30 to this 64%, anywhere in that neighborhood. You're doing this on an income generating basis. You're not betting on major swings in the price. You're not looking for big gaps up or down. You're just selling options. This is what I call part of what I call picking the low-hanging fruit of the market. Because this is money that is just out there waiting to be claimed. Most people don't, because honestly, they're too busy focused on big moves, trying to see the stock move from 32 to 35 or 40 or whatever it may be. That's why, even though this is a very, very impressive yield for 7 days, there's only been 3 contracts change hands. Because most people just don't even recognize that these opportunities are everywhere. So put a pin on Gibbs' comment. This is the major advantage in freeing the funds, is what you're able to do. Now, for a comparison to what I do, again, my normal method is to let the option expire. I let the result be the result. That means the next trade is that I place may or may not be CPB, I don't know. But I'm going to continue to work on the basis that I have. My average trade duration right now, let me look at my summary here just to make sure my average trade duration right now is about 19 days, as opposed to the 7 that we're talking about right now. That's in part because I actively take a trade like CPB, even though they're friends of ours that we all know that would be screaming right now, why aren't you placing this trade? Why aren't you doing this right now? My normal method is to let the option expire. That's what I'm going to do today. Why do I do that? Why am I passing up the extra return? Well, because it's a simplified version of the system. It's a little bit more passive. It doesn't work as actively, but it's also what's functional for my lifestyle, for the other needs needs and requirements of my life, my family, etc. Remember, investing is part of our lives. It's not our life, right? And so doing it the way that I do it is the way that it works in my case. But here's what I am actively giving up. And I talk about this not necessarily to say that one is better than another. I'm saying that if you are going to take a more conservative / passive approach like I do, you have to be willing to actively accept what I'm about to show you. Keep in mind that 64%. Okay, this is what I'm going to call the active approach to income generation. If you're looking for opportunities to buy options back before expiration on an active basis, you're actively doing that when price action is working in your favor. And some of the more active people in our community that we know, they will look for opportunities to do this if the premium has if the premium that they have to pay to buy the option back is 50% of the amount that they brought in when they placed the put sale. So they'll be very active, right? Here's the difference that even just a couple of days makes. This was a 7-day trade, right? And that's how we got to that 64% result. Now, I made 2% for a 23-day trade, and my average duration is 19 trades. Let's just go ahead and assume for a moment that I was able to do 2.03% every 19 days, just for the sake of argument. That means that 365 divided by 19, that means that I would be able to place 19 trades per year. Remember, to get that 64% result, we were talking about being able to place a trade every 7 days, 52 trades a year, right? So 19 trades per year. So 19 times 2.03, 38.5%. Now, for my money, I love this. This is great. And this means that I am right where I want to be. And anybody who says that this isn't a great result, I'm willing to argue with you about it. That's why I don't mind being a little bit more passive, because it still works out really, really nice. However, if you do want to be more active, what you are doing, you're giving yourself an advantage, which is trading frequency. Trading frequency is an advantage that I share with you because I'm a put seller and we're selling very short-term options, no more than a month. that gives us that gives us greater trading frequency than the average trader who is simply buying calls, buying puts, buying a stock outright, etc. Increasing our trading frequency increases the opportunity for compounding. And the compounding is what I've just shown you. Now, the compounding effect clearly for being able to place a trade every 19 days is not as high as if I were able to do it every week, every 7 days, the same result, the same trade. But I'm okay with that. I'm actively accepting that reality. So, really, what is the advantage? Yeah, you can absolutely increase your trading frequency. You can realize a larger overall amount of return, therefore greater income if you're doing it on a more active basis. There are some things that shift though. One of the reasons that I focus so much on put selling is because my trading probability, my success probability, annual on SPY right now is only 16%. Exactly. It's actually not too hard to keep up with the market. I'm not even trying to beat the S&P or the rest of the market. I don't care about that. I'm just trying to do what's functional for myself. But Gib, you made a great point. It's not hard to keep up or even beat the market when the average annualized return is 16% and I'm doing 30+% on a passive income, right? Let's talk about probability for a minute, because this is the other reason that I think put selling is so valuable. My probability of success. Here is my win-loss percentage. 98%. What does that mean? That means that the net result of my trades is 98%. It means I lose very infrequently. Now, I'm not saying that to brag, and to be clear, it doesn't mean that 98% of my put sales expire worthless. It means that the end result of a position that I create through a put sale has ended with a profitable result 98% of the time. To put that in context, that does mean, just like what Barry was talking about, getting caught with a good stock going through a bad time, that happens. Sometimes I get assigned stocks because they've dropped below the strike price that I sold, and I've watched those sit through extended long-term downward trends. I'm not afraid of those, and I actively accept them, and I try to ride those out because I believe in the business, and I keep track of what the overall fundamental strength of the business is. The only reason I will concede the point is if I see a material deterioration. And when I say material deterioration, I'm not talking about market-driven dynamics. I'm talking about structural problems within the company itself. Things that I think are going to take a very, very, very long time to fix. In some of those cases, depending on what the case is, I may not still believe that's strong enough to not continue to hold the stock. So I've held many of these stocks. I'm holding stocks right now that are, frankly, very, very well below the strike price that I sold on them. That means that I have I'm absorbing some declines in price right now that aren't showing up in these numbers because they're not realized results. So these are all on realized trades. Barry, I think once since I've been in the group, you suggested just to outright sell a stock. Yeah, it's about right. And if I remember right, Barry, that wasn't because there was a breakdown in the business, right? It was because the stock had picked up so much momentum and rallied so fast it was outpacing even what we were going to be doing with covered calls. And I just said, you know what, let's go for. I think my answer was let's go for the cash grab in that case, if I remember it right. Treat that as a gift. So this is the result of all of my, yeah, wasn't impatience but prudent. Thank you. So this 98% is the result, is the realized result of wins versus losses. And this is over an 11-year period of time. Now, that is reflective of the approach that I take, where I let the option expire, and then I accept whatever that result is. I've polled a lot of the people that I've worked with in in the Rebel Income group and community, who work on a little bit more active basis, to talk about what their probabilities are. And in those cases, it's their probabilities are a little bit lower. They're still very, very nice, very impressive. They're about 75 to 80% generally, but it's a little bit lower probability of success than mine. I'm not pointing that out, again, to brag or to say that what I am doing is better. I'm saying it's a difference. It's one of the differences that you have to account for in what kind of system you want to use. Barry, I believe it was 2021 sometime when I joined the group. A lot of things have changed, but you haven't. Well, thank you. I take that as a compliment. I appreciate that very much. What this is Jay, more active means more trades. That also means accepting. Thank you, Carl. I appreciate that. This also means if I'm going to be actively placing more trades, I'm going to accept the fact that I'm going to have a few more losses. It means that if I'm actively buying the option back before expiration, sometimes I'm doing it because the stock is breaking down and I want to minimize my loss. If you are an active put seller on the basis that we're talking about, then this becomes a really, really critical point. We haven't had that happen with CPB or with the other trades we've talked about so far, but that's one of the principles if you're going to be more active. That's why their probability, their win-loss percentage is a little bit lower, 75 to 80%. On the other hand, what they're seeing in very real results is not so dissimilar from the 38 versus 64% result that I showed you as an example. So the difference is real. The advantage of trading frequency and compounding is real. These aren't just idealized numbers, even though I'm simplifying for the purposes of education. The results are real. You just have to decide what is the result that you're after, what level of probability you want to work with, which of those works best in the context of all of the other questions that you have to answer about your life. That's it. Pretty simple. Well, I shouldn't say pretty simple, because it's a subjective question that all of us have to answer for ourselves, and there is no right answer. If you're following my trades, you see the way that I trade. You see the trades that I place and the way that I follow them, the way that I talk about here is something that that reflects the way that investing fits with my life, as I've already mentioned. That's not going to be something that I expect you to do the same way. You can. I highlight my trades so that you can follow them and possibly place them as well. But also, the purpose that I talk for talking about them here is to help you start to take the information I'm giving you in the trading alerts and then applying your own judgment to what you think is going to work best. Carl, the system works. CVS for me has finally become a gold for me, assigned at 50. Yeah, nice covered call trade. Yeah, if you're still holding it at 50 and it's at 72 now, yeah, that's awesome, Carl. And Carl, haven't given you one of these for a while, so I'm going to give you a big one. That's nice. Thank you. I appreciate that. Okay, Barry, looks like I'll be called out of my Delta Airlines $56 call today, and will my CGP funds will be released on my put sale. I may even be able to hold on to Walmart holding with the $100 call. So outstanding. Let's hit on those. And thank you for giving me a segue here. Delta is another stock that I am holding a position in. I sold the $59 strike, and Barry sold a little bit less. I sold a little bit higher. I went a little bit closer to the top. So here's Delta. I was looking at this before before the market opened. Well, I take it back. Looks like I'm going to be called out of this one as well. Here is the trade. All right, I was assigned Delta at 55. And I sold the $59 covered call, brought in $1.20. This was for a very nice 9-day trade, a little over 1 week, generated about 2% on this trade. Delta's move today and over the last few weeks is the kind of thing we call a gift, not something we expect, because I'm going to be assuming this continues to be the result. I'm going to be called out at 59 and have a $4 profit on top of the premiums that I generated, 85 cents when I placed my put sale, and $1.20. So that's $1.05 $2.05 in premium on top of a $4 capital gain. That's $6.05. That's really, really nice. That's not expected. Barry was assigned at 54, so you have a little bit less capital baked in, but profit's a profit, and that's exactly right. So Barry gets a check, and I'm going to go ahead and give myself one too. This kind of extra result is not what is anticipated. You don't expect to see this kind of number. It's nice when it happens. Don't get me wrong. I'm grateful for it, excited about it even, but it's not expected. Typically, when I sell a covered call, it's usually very near the price that I was assigned at, maybe a little bit above by $1 or sometimes a little bit more than that, but not much. So to be able to sell $4 above that the price that I was assigned at for a stock that I've really only held for a week. Well, about 3 weeks. I take it back. Held it for about 3 weeks, and to be called out at 59, that's attractive. So, and Barry, congratulations to you too. I like it when people are able to see these kinds of results as well. The other trade that I have on deck, and we're running low on time, so I'll just hit on this one really quickly, is on Comcast, selling the 32.50 strike price, brought in, again, a 9-day trade, brought in a little over 1.5%. 1.5% is my normal target for a month. So to be able to get even a little bit below that, or above that, excuse me, for a 9-day trade, that was really, really nice. Comcast right now is at 32.34. So this is looking so far like I might 34, excuse me. Wow. I can do math. I think maybe I selected Campbell Soup first. 32.50 is the strike price that I sold. So that's all the way down here. So this looks like another result similar to CPB, where the stock is showing some good strength, and looks like this will expire worthless. So that's a nice overall result. Again, the momentum here offers an opportunity to think about, whether to buy it back or not. We're out of time, so I'm going to let you run the numbers. If you're using the same trade, make your own decision. Barry is still in MGA, wrote a 47.50 call order for September 19th. You were assigned at 42.50 a while ago. So check in on that one. There you go. This is showing some good strength. So if you can get some, if it gets up here into the 47.50 range, you're already sitting there very nicely. Thank you, Jay. You have a great weekend as well. So this is a very, very nice trade as well, Barry. Great result. Good job. And sorry, I needed to account for CPB. So there's another one, and be able to hold on to Walmart with the $100 call. So there you go. And for good measure, there. All right. Everybody, thank you so much for your participation. As always, I do appreciate it. Hope you have a wonderful weekend. If you have any questions between now and then, now and next Friday, I mean, please don't hesitate to reach out. rebelincomesystem@gmail.com is my email address. Gib, as I mentioned, I will respond to you this weekend. I apologize for the delay. So it's week 0. There you go. All right. Everybody, thank you again for your time, and we'll talk again next week. See ya.